After a heated election, feels like we're seeing unprecedented agreement on housing policy. Both major parties campaigned on similar solutions. And given that we saw 85% of Canadians vote for just two parties, according to the Globe and Mail, the majority of Canadians voted for very similar housing policy. Here's what that means for the next 40 years. Firstly, there's broad agreement on building more homes, with the Liberal government targeting 500,000 units annually and the Conservative platform targeting 300,000. They're likely to support this. This includes a major push for purpose-built rentals and social housing, developed at a record pace, as much as 6% of the total rental supply currently under construction. This is obviously going to have far-reaching implications for the rental market, for rental rates, vacancy rates, and house prices. If population growth policy holds, we'll see more supply, more vacancy, lower rents, and potentially lower prices. Secondly, both platforms proposed some sort of tax relief, either lower GST on new builds, some investor incentives through the MERB program, and the 1031 SAL exchanges. So first-time buyers will likely see some support through various programs, and investors are being acknowledged for the role that they have and are actually being given some preferential tax treatment as well. This is going to continue to make it improved incentive for people to create housing. This shift towards rental and social housing could mean continued pressure on the rental market. For tenants, this is actually good news. More supply typically means more competitive rents. However, investors are facing a triple challenge: falling property values, higher interest rates, and potentially higher vacancy rates as this new supply comes online. This transition comes during significant economic uncertainty. RBC isn't forecasting a technical recession, but Deloitte's economic outlook is anticipating a recession. So the next 4 years will likely see a significant transformation in Canadian housing. We've already been seeing that take place just by market forces, with prices falling, rents falling in a lot of markets across Canada. We're going to be moving from an ownership-focused market to a more balanced mix of rental and potentially social housing options. Whether this achieves the goal of improved affordability while maintaining market stability remains to be seen. For investors, it's time to adapt your strategies. And for renters and buyers, patience through this transition period could pay off. One of the ways that I've really found it to be good to stay updated on these changes is to check out these market reports put out by LIV.RENT. We're pretty on the ball. I posted a lot of their charts on Twitter and other platforms. Pretty on the ball when it came to the changes in non-permanent residents populations in different provinces, which is the chart I'm showing here, as well as the significant decline in net non-permanent residents that Canada was seeing, which ultimately is the biggest potential impact factor in the rental market and rental pricing in Canada, as observed by the Bank of Canada in this chart. Strong population growth is supporting inflation and rental prices. Among those annual reports, they have a handful of really solid reports on a municipal level as well. They cover all the major markets in Canada: Toronto, Vancouver, Montreal, and the two Alberta markets. We've been using these a lot for research on the podcast, to advise investor clients, and to make market decisions for our own capital. I'd encourage you to check it out.